if indeed the Reserve Bank is able to achieve, a stable, if not 4%, at least a 5% inflation over the 2 years that we have been talking about, will that up the valuation matrix because it's going to be a stable inflation country?
Well, it depends what happens to valuations globally, clearly. But that multiple I just gave for India is a little bit below the multiple on the S&P and on Europe, and we think is more than fair for the return on equity that India delivers right now. And we at the peak we're trading about 60% forward PE premium to emerging markets. That was late last year. That's now almost halved, particularly with the underperformance we saw January through March.
Chetan spoke about several indicators, especially capital goods imports increasing and order books rising. So what would a sector-wise strategy be, or a stock-wise strategy be?
Well, I can't talk about stocks, but on the sector side, we certainly like consumer cyclicals and industrial cyclicals. And that's pretty well the opposite of our view on other large emerging markets, say like China, where growth is still decelerating. Where we're still very cautious is on sectors like materials. And indeed, when we look at where we've seen relatively poor earnings performance, telecoms has been a little bit disappointing in India.
Okay. I'll want to come back to China for a minute with you, but before that, since we have started talking sectors, the golden sectors, whenever Indian economy doesn't perform well, have been the defensives, IT and pharma. You think their golden age is over for the moment?
Well, it depends a little bit on what happens to the rupee. So we're assuming that the rupee remains roughly where it is now, about 64 to the dollar going forward. But if you were to head to a more adverse global environment around a strong dollar and rising US rates, then those sectors do tend to come into their own, yes.
Okay, but okay, then let's finish that argument. When are you expecting the Fed rate hike? What might be the US bond yields at that time? And therefore, what may be the impact on India's at least two macros, yields and currency?
Well, on the currency, I gave the forecast already, and that's predicated on the idea that the current account remains roughly where it is, that we don't get a particularly, say, negative monsoon or a big spike in oil, which Chetan was talking about earlier. We don't think that's very likely. So we'd assume that the current account stays roughly where it is. And then in terms of the actual first Fed rate hike, that's likely to be in December, but the Fed will go quite slowly, in our view. And bond yields, 10-year yields, we think go back up to about 2.8, 2.6 to 2.8 by early next year. So, we've had a pretty sudden adjustment in bond yields. That's certainly why emerging markets have been performing so badly in the last 3 or 4 weeks. We wouldn't expect it to continue at this pace.
Okay. What's your sense, Chetan, if bond yields go to 2.8, 2.9 by early 2016, would not that impact Indian yields?
Well, it should, but I think you should not look at nominal. You should look at real yields. So to the extent to which inflation is then going to be below 5 as per our forecast, we think that real rate levels in India would be significantly high enough to ensure that the premium between India and US real interest rates are still reasonable enough not to be worried about this fact. And mind you also the fact, as Jonathan mentioned, current account balance is important. If the current account balance is around 1.5 or below, that is equal to about our net FDI and some long-term flows that we get. India doesn't need to have a big premium over US, but you can still safely assume to have some real premium over the US 10-year bond yield, and we should be still fine. Because at the time when Jonathan mentioned about the 10-year bond yield in the US to be at 2.6, 2.8, we are expecting inflation to be at about 2. So we're still talking about 0.6 or 0.8% real rates on the US 10-year. So that should not be too hard to swallow for India and cause any stress here.
You expect inflation to be at 2, that is WPI?
I'm talking about the US inflation, sorry.
Oh, sorry. Okay. Jonathan,
WPI we're expecting to be 1, actually.
Okay. Yeah. No, let me finish this other global arguments. You don't expect a commodity resurgence or the crude resurgence at all. What's the Morgan Stanley picture on crude, which is one big worry for India?
Well, I think when you look at the supply-demand balance, demand has actually picked up a little bit in the crude markets this year, but OPEC's keeping the market very well supplied, and that's basically their strategy, which is to slow down the development of the shale sector. That's why we think it's extremely unlikely that oil goes back to $100 a barrel. It's probably going to range trade roughly around where we are right now. And then for the other commodities, I guess the industrial metals and things like thermal coal, it's really all hinges on China's capex cycle and China's industrial cycle, which is still looking very weak to us. There are some bright points in the China economy, in the consumer and services sector, but the overall momentum in China's economy is really quite weak at the moment, continues to be quite weak.
Well, in that context, let me come to that China question. We saw this extraordinary performance of Chinese equity markets, and India was at that time, declining with every day. Was there an instance of Indian money going to China? How do you explain that those 8 weeks from mid-April?
Yes, I think you meaning were foreign investors switching money from Indian equities to China equities. There's not really that much evidence for that. I mean, the overweight of India did decline somewhat from about 800 basis points overweight to about 600. The long-run average overweight for India is about 400. But if there was switching, it probably was more towards Japan, in fact, which has moved to a more positive stance in global portfolios. Most foreign clients have not participated in this China rally, which has been mainly concentrated in the onshore A-share markets.
Okay. Nevertheless, the China contradiction is a little difficult to understand for an Indian investor. When we speak to economists like Chetan, they are continually telling us that China is going to do worse with each passing year in terms of GDP growth. And yet we saw this extraordinary performance in the stock markets. Do you think that stock market performance won't sustain?
Well, if you look at the A-share market, we've argued that the risk-reward has deteriorated, and that going forward it's getting less attractive. For the offshore market, the MSCI China, we downgraded from overweight to equal weight recently. MSCI China had outperformed emerging markets about 4,000 basis points over a year. So again, in terms of booking profits on that and rotating towards India that had underperformed recently, that's what we've been trying to do.
What is your forecast of China, Chetan?
So the headline number is something that we have to try and predict as to where the official numbers will be. So that's around 7. But the industrial China, or the one which matters for the rest of the world, which is what is measured in MS checks, as we call it, is in a recession condition. Or the other number to look at would be non-oil import growth in China. That's averaging about minus 15% in the first 4 months of the year. So, I would say that we rather look at these indicators to know what's going on China in terms of growth trajectory.
Okay. Well, last 2 questions to you since I'm being warned. Chetan, considering the kind of inflation forecast you have, how many more rate cuts are you expecting from the Reserve Bank?
We're expecting another 50 to 75 basis points by March 16.
So what might be either the 10-year yields or base rate for that matter? You see that also falling by about 1 percentage point, the cost of money in India for borrowers?
That's right. I would say that you have to look at the weighted average yields on loans and advances. That would probably be down by about 75 to 100 basis points. And the other measure could be looking at commercial paper rate, which is already actually down quite significantly. That could also be down by another 75 to 100 basis points in another 6 to 7 months' time.
Well, you are in good company. Aditya Puri of HDFC Bank also told us that he expects base rates to fall by about 100 basis points, or at least 75 basis points in the next 12 months. Jonathan, last question to you. You gave us an earnings forecast. How much do you think the Nifty or the Sensex might gain in the next 12 months and in the next 24 months, if that's a more comfortable time period?
I think getting back above 30,000 on Sensex is really quite likely, and that's the target that my colleague Ridham Desai has. So kind of a weighted scenario probability of going back above 30,000 on Sensex a year from now would seem likely to us.
Okay, but more in terms of equity returns over the next 12, 24 months?
Well, I guess you're going to see probably sort of reasonable double-digit returns from here for the dollar investor and indeed for the rupee investor, given we think the rupee is likely to be reasonably stable. Okay, so
can we, would it be realistic to expect a 15% equity return in the next 12 months and another 15 thereafter as well?
I would say 10 to 15% 12 months out, and then obviously we'd want to review the situation. But that is much better than the forecast we have for emerging markets overall, where we have maybe 3 to 5% upside.
All right. Thank you very much, gentlemen, not only for cheering the markets up, cheering our sentiment up. I also hope that you have a very successful conference.
Thank you.
Thank you.